There you go.
Hey traders, Cousin Vinny coming to you from theclosingprint.com on October the 12th, Sunday, with a look at the week ahead. Obviously, we got clocked again last week. Bulls that were reluctant to accept the trend change have suffered the consequences, and being the month of October is not totally unexpected. However, the number of stocks trading above their 50-period moving average on both the S&P 500 and the NASDAQ are both oversold and in areas where we normally have seen changes of trend or momentum in the past. Doesn't mean it will happen, it just means we need to watch it. Looking at a chart of the comp where we've sliced through the 200-period moving average, we are beyond 3 standard deviations. This is 2 standard deviations of Bollinger Bands, and we could likely see a bounce on Friday. It's not a promise, but it's something that we're considering. Stochastics is oversold. Both our momentum indicators are moving lower, and as I mentioned, the NDX A50R is down at 19. Areas where we've seen turns in the past, like we saw in April, which resulted in a rally, and also in August, which did the same. So the S&P 500 is at the 200-period moving average. We also had an area of previous support, and the SPX A50R, number of stocks trading above their 50-period moving average, is at 24.20. That's an area where we've normally seen a bounce in the past. Okay, doesn't mean it's going to happen this time around. It's just another thing that we need to focus on. Monitoring our tick cumulative chart, we are continuing to move lower. We thought we might flatten out here and turn. Such is not the case. We'll look for that to happen this week. Note the severity and the length of time that we've been moving lower on extreme low ticks. Low ticks typically mean institutions are getting out at the bid. They don't care, they're just selling. So we could see this also playing out with regard to margin. A lot of good stocks out there are getting thrown away with the baby with the bathwater. We are, again, at the 200-period moving average. With regard to NYMO, we are moving lower as well. Trend was higher last week. We're looking for these two to move away from each other to give us an indication that we may see a bounce, and we'll be watching for a tick to accumulate positive 800, positive 1,000 ticks. More than 12 to 15 of those on Monday would be a sure sign that we might see a bounce. We'd also like to see a follow-through on Tuesday with the same thing happening. Now, with regard to major distribution days, we've had 2 thus far. Last week was an 11-to-1 down volume versus up volume. That was a pretty significant move to the downside, obviously. Thursday having a 11-to-1 down volume versus up volume day, a MDD, and also a follow-through on Friday, which came out to be around 5.32 to 1, which was still significant, but we have yet to see a major accumulation day. We want to see that occur soon if this rally is going to be saved and we see a bounce going forward. Looking at the Russell, of course, we have around 1030, which lines up with the 382 Fibonacci from the last time we lost the 200 period, which is the blue line, the 40 week, obviously 5 days in a week. The 200 period we lost, and we continue to move lower. Now, what we're looking at is the 382 right around 1030, 1035. Is around a 15% correction from the highs at 1213.55. Okay, but we are oversold. Slow Stow is starting to turn, it appears. So we could see, what we want to see is accumulation here before we do anything. We want to see smart money coming in and start supporting this at the 382 level. If that breaks, we have a previous level at the 2011 lows up to the highs at 1213.55. The 382 is almost a 20% correction. So if we hit beyond 20%, that would be a bear market on the Russell. The way we play the Russell and small caps is through the American Beacon Small Cap Value Fund, AVFIX, and we can see similar weakness here as well. Note the 382 Fibonacci level would be a 14.79% pullback. We are waiting here as well, looking for slow stow, which is already starting to turn on this well-managed American Beacon Fund, for a signal that we may be able to take a long. Again, we're waiting to see accumulation, so we'll be watching this on a daily basis on the Russell as well as the AVFIX going forward. We want to see risk on, return to the small caps. So right now the small caps, mid caps on the S&P are doing poorly at present. The risk event indicator, the VIX to VXV ratio, is up at 1.07, historically significant, and in an area where we might see a reversal in this indicator in the very near future. Now, if we look at the VIX, VXV from the standpoint of a 6-year study, we can see 1.13, 1.11 is a significant level for a reversal in the markets. And what had happened previously when that occurred shortly thereafter on the indices, especially the SPX. Okay, now if we look at this overlay, if we look at this and overlay standard deviations, that gives us another look that this is the 2 standard deviation, 3 standard deviation, which we made it through, which is 1.07, and 3 standard deviations, which include 99.7% of all price action and statistical dispersion from the mean. We're very close to a 4 sigma event. So that would be 4 standard deviations and a likely area of a turn in this indicator. Note that 2008 was a 6 sigma event, so the likelihood of seeing another one of those under the current circumstances with XLF and XLK starting to show signs of life, I don't think that's going to happen, but we will be monitoring for changes in this indicator in the week ahead. Now this is the XLP XLY consumer staples to consumer discretionary or the cyclical sector ratio, and back in September, first week of September, we were watching this for a breakout where staples would outperform cyclicals. Typically cyclicals would outperform in an improving economy. Obviously smart money didn't believe what the data was showing from the Fed, so we saw staples outperform. Now we're getting to an area where we could see a crescendo or a change in trend. So this is getting very elevated and starting to go parabolic. Just keep that in mind going into the week ahead. We have some positive things happening, so it's not advisable to jump out of a window yet. Perhaps just leave one open. If you have a desire to commit hara-kiri over what seems to be an extreme condition, obviously, and one which could reverse any day and catch the bears off guard very quickly. Now, looking at October in particular, it's statistically significant. As of 1900, I think we've seen something like 69 major trend changes, but only 9 to 11, depending on what research you look at, took place in October. This particular one was a comment in a MarketWatch article talking about the worst failures on or trend changes on the market in the markets were during the month of October. Obviously, the biggest one that we're aware of that we've lived through is minus 22.61% on the October 1987 crash. Does that mean this is going to happen? Consider the fact that we've had 69 major trend changes since 1900, and only 9 to 11 of them have occurred during the month of October. So with indicators already oversold, we could very well see a bounce in the week ahead. Doesn't mean it's a promise, it just means that's what I'm starting to anticipate. We have to see confirmation, and we'll look to our tick cumulative, the trend, as well as NYMO to give us an idea of where we might be going in the near future on the major indices. Okay? This is Cousin Vinny coming to you from theclosingprint.com with a look at the week ahead. I hope this helps. Be sure to come and check out the site. We have a number of videos at the top of the page, 5 or 6, that will help you as a new trader to navigate the markets. Currently, we are 100% cash in our 401k, IRA, and the kids' 529 investment plans. I did post an analysis of where we are with respect to our investment accounts over the weekend. You can check that out by going to our blog site, theclosingprint.com, and just check right here, and that'll lead you to the blog. Okay? Again, I hope this helps. Take care, and we'll talk to you on Monday. More than likely, I will post a watch list going into the week, both short and long positions, if I have a chance to. It's really nice out, so I may just take the day off and write something later tonight. Be sure to check out the blog on Monday morning, however, because typically I will post something early in the morning. Okay? Take care, and we'll talk to you soon.